Hi everyone, welcome back to my channel, and today's video is about the adjusting entries. How do we define adjusting entries? These are journal entries which are to be recorded in the general journal, which are usually prepared at the end of the accounting period of 1 year, or it can be also prepared at the end of the month or at the end of the quarter. The purpose of this is to bring balances of assets, liabilities, revenues, and expenses updated. We have various types of adjusting entries such as the following: accruals, prepayments of expenses, pre-collections of income, provision of depreciation for property, plant and equipment, or what we call the fixed assets, adjustment of inventories, which is typical under merchandising and manufacturing concern, and lastly, correction of erroneous journal entries. In accounting, accrual means to recognize revenue or income earned regardless of when it is collected, and we call that one accrued income. And also to record expenses incurred whether paid or not, and we call that one accrued expenses. We have pro forma entries to record accrued income and accrued expenses. To record the accrued income, we have to debit appropriate receivable account and we will credit appropriate income account. On the other hand, to record accrued expenses, we debit appropriate expense account and we will credit the appropriate liability account. To understand this concept, let us have this transaction. A building owned by Annie Vine was partly rented by Forges Company for $10,000 per month. Please take note, payable every 10th of the following month, and we are required to prepare the adjusting entry on December 31, 2020. Let me ask you this question. In the books of Annie Vine, the owner of building, when will be the December 2020 rental will be collected? And in the books of Forges Company, when will be the December 2020 rental be paid? The answer is on January 10, 2021. You can observe that 2020 and 2021 are two different and separate accounting periods. On the part of Annie Vine, the revenue was already earned in 2020, although collection will be received in 2021. On the part of Forges Company, the rental expense was already incurred in 2020, but payment will be made in 2021. Therefore, Annie Vine should record the income earned, although it is not yet received, by debiting accrued rent income $10,000 and crediting rental income $10,000, or we can have this entry. Okay? So that's it. What you can observe in that entry? As you can see, this entry increases both asset and revenue account. While for Forges Company, it should record the expenses incurred, although it's not yet paid, by debiting rent expense, of course $10,000, and crediting accrued rent expense $10,000, or we can have this entry. Of course, as you can see, in our entry, it increases both our expenses and our liability account. That's all about the accruals. Now let's proceed to the prepayment of expenses. This is an expense that is already paid but not incurred. This is the exact opposite of the accrued expenses, or shall I say, these are advance payments of business expenses or supplies to be used in a business operation. These transactions may be recorded initially as prepaid assets or prepaid expenses, which expire either with the passage of time, such as insurance and rent, or through usage or consumption, as in the case of supplies. Okay, we have two methods in recording such prepayment of expenses: the asset method and the expense method. Alright, we have the pro forma entries to record the prepayments of expenses. Using the asset method, we debit appropriate prepaid asset account. Please take note, it is an asset accounting element, and we will credit the cash. Alright? while for using the expense method, advance payment is initially recorded as expenses, so that would be our pro forma entry. Okay? To illustrate that one, let us have this transaction. Okay? On October 31, 2020, Julia paid in advance an insurance premium for $12,000 covering a period of 1 year. We are required to prepare journal entry on October 31, 2020 and adjusting entry on December 31, 2020. Now we will record upon payment of our insurance premium. So we will debit using, under the asset method rather, we will debit prepaid insurance and we will credit cash for the value parted with. Okay? On the other hand, using the expense method, we will debit the payment of insurance premium by using this account. Debit insurance expense, 12,000. We will credit cash, 12,000. As what you can observe, the clue in the preparation of the appropriate accounts is the transaction itself, like this one. So insurance. So therefore, this pertains to the prepaid insurance. And using the expense method, insurance expense. Alright. Prior to the preparation of the balance sheet, the prepayment is partly asset and partly expense. Thus, there is a need to adjust it for the purpose of segregating the expense portion or the expired portion from the asset portion of the mixed accounts. Okay, this is a mixed account, this is a mixed account. Okay, on December 31, 2020. Let us analyze it further. In the case of asset method, okay, prepaid insurance is not true by the time when the date is December 31, 2020. Why? Because November, December already expired. Therefore, portion of this corresponding to 2 months represents our expense. So therefore, we will have this entry on December 31, 2020. This represents again 2 months. Okay, and we will decrease our asset account by 2,000. Alright. For the expense method, on December 31, 2020, it is overstated. Why? Because the actual insurance expense is only for 2 months. Therefore, we need to set up or to establish the asset portion of this. That's why we have this adjusting entry. We debit prepaid insurance 10,000 representing 10 months of the insurance premium. Okay, and we will credit insurance expense 10,000. Okay. Now, let me show you the adjusted balance using both the asset and expense method. Okay, let me prepare to you a T account because we are going to pause in our T account our entries made on October 31 and on December 31, 2020. Alright, so on October 31, under asset method, we debit prepaid insurance, okay, and we credit cash. Okay, and on December 31, we made a debit of insurance expense and we credit prepaid insurance. Okay, and we will take the balance, we'll get the balance. So how we get the balance? That is 12,000 less 2, that is 10,000. Or if you are keen enough to observe the 10,000, this represents the unexpired portion. Please remember again, please take a look in our transaction. It is a 1-year premium coverage. Okay, wherein the time starts or the period starts from November 1, 2020. So therefore, at the end of December 31, 2020, we have 10 months unexpired. So that represents our corrected balance for prepaid insurance. This 2,000 represents the expired portion. Using the expense method, as you can observe, if we pause that one, okay, even if the two methods are different from each other, the final adjustment is just the same. Okay, so prepaid insurance here is the same. 10,000, 10,000, insurance expense, 2,000, 2,000. Alright, that is an example for our discussion about prepayment of expenses. Let us proceed in the pre-collection of income. Okay, this is also known as the deferral or the deferred revenue. These are advance collections made of business revenues from customers, and definitely upon receipt of the cash payments, these are not yet earned by the business, right? As you can see in the slide, the cash collections may be recognized initially as revenue or liability. So that's why we have two methods here in the treatment or in the recording of the pre-collection of income. Okay? And our pro forma entries to records upon receipt of the pre-collections or advance payments made by our customers using the liability method. Of course, since we receive cash, so we debit cash and we credit appropriate unearned revenue account. Please note that this unearned revenue is a liability account. Alright, let's move on. On the other hand, using the revenue method, okay, of course, we debit cash and we will credit appropriate revenue account as the method suggesting to us, alright? Alright, let's continue. Okay, and our adjusting entry under the liability method is that we have to adjust this one because at the end of the accounting period, this is not true anymore if there is a revenue earned during that period. So that's why our entry would be to adjust the liability account and to recognize or record the revenue account. And using the revenue method, alright, we have to adjust this one because some portion of this will be still unearned or still be a liability, alright? That's why our journal entry would be debit appropriate revenue account, and we will record or establish the liability account, the unearned revenue account. To understand it further, let us assume this transaction. Okay? On October 1, 2020, Dance Realty Company collected $12,000 from a tenant. Please take note covering a period of 1 year. You are required to prepare journal entry on October 1, 2020 and adjusting entry on December 31, 2020. Under the liability method, the entry upon receipt of the advance collection is this. We debit cash, how much? 12,000, and we will credit a liability account, unearned rent income. Our clue here is that this appropriate liability account is here, rent. Okay, rent here. Tenant connotes rental, alright? Okay, and using the revenue method, of course, the same debit, but the credit is initially recorded as rent income, a revenue account. Alright, at the end of the accounting period as of December 31, 2020, okay, these are mixed accounts already. Portion of this, okay, will be earned already or expired. Why? Because that is the 12,000 represents for 1 year. Therefore, our monthly rental, okay, or rent income should be 1,000 per month. And since it started on October 1, 2020, therefore, as of December 31 or for the period ended rather December 31, 2020, we have 3 months, alright? That is October, November, December. So meaning to say, the unearned rent income should only represent how many months? 9 months. Or should I ask you this way? Or should I say like this way? That our revenue earned here is for 3 months, again from October to December. Therefore, our entry would be to adjust this liability account and to recognize the revenue earned. Therefore, our adjusting entry on December 31, 2020 would be like this. Okay, to adjust the unearned rent income, 3,000, and to recognize the revenue earned, 3,000. Alright, let's continue on the revenue method. This is overstated since 3 months is only the actual rent income. Therefore, there is a need to establish or to recognize the liability account. So this is our entry. Okay? Regardless of the method that we were using, of course, the adjusted balance that we can derive for the period ended December 31, 2020 is just the same as what I presented to you a while ago when we discussed prepayments of expenses. Alright? So that's it. Okay. So as you can observe, here, the unearned rent income is the same with this one. The rent income is the same with the revenue method. Alright, let's continue. Next topic is about the depreciation. What is depreciation all about? It is the allocation of the depreciable cost of the tangible assets or property, plant and equipment used in the business over its estimated useful life. Okay, that is usually expressed in years in accordance with the systematic and rational allocation expense principle of accounting. Tangible assets means the property, plant, and equipment except land such as building, furniture, and fixtures and equipments which are used in the business but not recorded as inventory for sale. Okay? Since those assets are expected to provide benefits over several years to the business, these are first be recorded as assets, okay? And the cost is gradually expired over its estimated useful life as expressed in this formula. Okay? We'll be using the straight line method in our presentation. So this is our formula to compute the annual depreciation cost of the asset less the salvage value. This is our salvage values meaning over the estimated useful life. Right? So, as what I mentioned a while ago, we'll be using straight line method. Okay? But if you want to know in advance, there's a lot of the method on how to compute the depreciation expense. Alright? Let us have this illustration. On October 1, 2020, 2P Hardware acquired air conditioning unit for office use costing $80,000. Freight paid was $5,000 and installation cost was $15,000. The estimated useful life is 5 years and the residual value of $10,000. Okay? If we're going to substitute the figures in our formula, therefore, we can have this one. How much would be our cost of the asset? It should be the purchase price of $80,000 plus the freight cost of $5,000 plus installation cost of $15,000. Alright? So, our annual depreciation would be 18,000 pesos. Please note, okay, that we made the purchase or the acquisition on October 1, 2021 and we are required to prepare journal entries on December 31, 2020. Okay, so our entry would be to take up the depreciation expense. Okay, the amount is 4,500. How we get 4,500? Since 18,000 represents 1 year, therefore we have to divide that one to 12 months multiplied by 3 months, or that is from October, November, December, or you can have this presentation. 18,000 times 3 over 12, we get 4,500. So this is our entry. Okay. And of course, the explanation. Alright, let us continue. Using our journal entries to take up the depreciation expense, okay, the depreciation expense account is reported in the income statement as shown in this presentation. Okay? What I'm presenting to you is a sample format of an income statement for the period ended December 31, 2020. We have here, of course, the revenues as the first line, and we have to deduct our operating expenses, assuming we have taxes and licenses, and I have to incorporate the depreciation expense as what shown in our previous journal entries, so it must be look like this. So we have either income or loss. Correction please, additional S, alright? Let's continue. What happened to the accumulated depreciation thus office equipment? This is a contra asset account or contra account of the office equipment, an asset rather. Therefore, that is presented in our statement of financial position, or what we call the balance sheet, and it must show like this one. Okay, so I am just showing to you portion of our balance sheet. First line here is the assets, assuming we have the cash here, and this is our problem. We have office equipment costing 18,000, and this is where our accumulated depreciation is. It is deducted against the office equipment, and the amount or the figure that we can get is what we call the net book value. All right, so we have learned a lot of terminologies as I discussed to you the concept, everything that I am presenting to you. Now let's continue. Now let's proceed to the estimated uncollectible accounts. What is this all about? When accounts receivable are already long overdue, some percentage or portion of this amount will be adjusted as uncollectible accounts or bad debts or doubtful accounts and recorded as expense. And we have these pro forma entries. We debit bad debts, we credit allowance for bad debts, or alternatively, we can have this account title. Uncollectible accounts is just same with the bad debts, and we credit allowance for uncollectible accounts. Alright, so this is our pro forma entries. Other textbook says that it can also be used here, doubtful accounts. So therefore, we will credit allowance for doubtful accounts. Okay, how we get the estimated uncollectible accounts? Okay, it can have the following basis: by setting up certain percentage based on outstanding balance, aging of accounts receivable, and lastly, by setting up certain percentage based on credit sales. Let us continue. Okay, again, let me go back. This is an expense account. Of course, it will be shown under the income statement, and this is a reduction from accounts receivable. Therefore, it is presented under the balance sheet. Let us continue. Okay, let us have this illustration. Assume that, anyway, we'll be using allowance method here. Assume that the business has outstanding accounts receivable from various customers in the amount of 40,000. And on December 31, 2020, it is estimated that 5% of this is uncollectible. Okay, please take note that using a certain percentage based on outstanding balance or based on accounts receivable, please take note that whatever that can be computed here will represent our required balance. So you don't need to worry on what to do, because as I am going to reiterate, what will be computed here will be our required balance. Mean to say, you have to consider if there is a beginning balance in the records or in the books of accounts. So our entry would be uncollectible accounts 2,000, and we will credit allowance for uncollectible accounts 2,000. What if the business has the following data? We have the accounts receivable 40,000. We have existing balance of 500. On December 31, 2020, it is estimated that 5% of this is uncollectible. As what I've said a while ago, whatever will be the computation or the result of the computation, this will represent our required balance. So our required balance here is 2,000, and please consider that we have a beginning balance here. Therefore, we just need additional 1,500, okay? That is 2,000 the required balance less the beginning balance or the balance before the adjustment. Therefore, we need only 1,500 and we will credit allowance for uncollectible accounts 1,500. So that's it. If we're going to present that one using the percentage based on outstanding balance. Let us continue by setting up certain percentage based on credit sales. Please take note that whatever will be the computation that will represent our expense. Okay, so that's it. So we are going to assume this transaction. Assume that the business has the following data. We have the sales 500,000, accounts receivable 40,000, and we have here allowance for uncollectible accounts 500. On December 31, 2020, it is estimated that 1% of sales are deemed uncollectible. We are required to prepare an entry to take up bad debts expense. How to do that one? Okay, whatever will be the computation automatic, that will be our entry. So we'll debit uncollectible accounts 5,000 and we will credit allowance for uncollectible accounts 5,000. Of course, the explanation to set up provision for doubtful accounts. Alright, so if we're going to present that one in the respective financial statement, since uncollectible accounts is an expense account, therefore it will be included here or presented under the income statement. So it must look like this. Okay, so that's it. While the allowance for uncollectible accounts is a contra asset account of receivable account, so it must be deducted against the receivable account. So the difference here will represent our net realizable value. So this is the picture if financial statements will be prepared. Alright, so let us have this problem as given to you last week. The ledger of Hamad Incorporated on March 31, 2020 includes the following selected accounts before adjusting entries. Here, we have the prepaid insurance, 36, office supplies, 28, office equipment, 25,000, contra asset account of office equipment, 5,000, and revenue a liability account, 9,200. And we have here transactions that need analysis so that we can come up the adjusting entries for the month of March. Insurance expires at the rate of 100 per month. Therefore, out of this 3,600, the analysis would be that 100 pesos out of this expires every month. So therefore, this is overstated now by 100 on March 31, 2020. Therefore, our first adjusting entry would be to debit insurance expense 100 and we will decrease our prepaid insurance by 100 by crediting it. Of course, the explanation. Alright, let's continue. Transaction number 2. Supplies on hand is only valued at 800. Please take note that in the above balance, it is 2,800. Therefore, it is overstated by how much? By 2,000. Since this is a asset account, to decrease it, we have to credit it. Therefore, our entry would be debit supplies expense 2,000 and we credit office supplies 2,000. Alright. Transaction number 3. The office equipment depreciates 200 per month. So we don't need to compute anymore because it is already provided in this transaction or in this problem. So therefore, all we have to do is to take up the depreciation expense by how much? 200. And of course, we will credit its partner the accumulated depreciation of his equipment 200. And lastly, 1/2 of the unearned revenue. This is a liability account. It is earned in March. Therefore, out of this, 50% of this or 1/2 is already earned. Therefore, there is a need to recognize or to record the revenue by how much? That is 9,200 divided by 2 or that is 4,600. So this is the answer of your problem for last week problem. So this is the recap of our presentation. Points to remember. Okay, that's one. Please take note of this last slide. So thank you so much for watching. Hope that you learned somehow. Up next, preparation of worksheet and financial statements. So if you want to be notified, you may hit the subscribe and see you in my next video. Thank you.